let's bring in our market panel as we did set those new records for the Dow and S&P 500. Joining us, Fundstrat co-founder Tom Lee and Jefferies chief market strategist David Zervos. Both Tom and David are CNBC contributors. Guys, happy Friday. David, coming off that rates impact for the government there, what do you see coming for rates? How long will it take us to get to neutral? How will that affect stocks and fixed income from here?
Well, I think that is actually one of the biggest questions out there, not just for fixed income investors, but for equity investors. I think the speed with which we get to about 3.5 is probably pretty quick. It could be as fast as mid-year. And then I think the debate about neutral starts. And that could be a pretty kind of risky, bumpy, messy debate. I think a lot of people around the FOMC table have raised their neutral rate forecast. And as we've been writing at Jefferies for the last couple of months, we think that might be a pretty big mistake as the balance sheet contracts and gets back to a more neutral level. So I'm looking for actually rates to go back to 2019 levels eventually, which would be music to the ears of commercial real estate, private equity, and venture guys, and probably my friend Tom over there for equity multiples as well. But I think it might take a little while, and there's going to be a big debate as we go through 2025 and into 26.
All right. Well, Tom, speaking of equities, I'm going to do something rare, mostly because it's funny, and give you a hard time for not being bullish enough. 6 weeks ago, you warned about a potential 10% pullback in the S&P in the next 8 weeks. We're up 6.5%, I think, since then. Now, you did say to buy any dips if that were to happen. But do you see any more potential icebergs? What do you think got us this far?
Well, John, the stock market in the last 6 weeks has proven its character, which it's had all year. The S&P is incredibly strong this year. It's been up now 9 of 10 months. And you're right, we got fooled by seasonality because I figured, well, between now and Election Day, there's a heightened possibility of some type of correction. We weren't saying you want to sell stocks. I think it's always a mistake when people panic sell because we, literally in the same paragraph said, but if it does pull back, you want to buy that dip. And I think we're still in that tricky period until after Election Day. But that doesn't mean I think investors should be bearish right now. I think we have a really good fundamental backdrop. I mean, look, if David's view is correct, 3.5% 3.5% Fed funds rate is very supportive of the economy. It's going to really take housing and autos and durables out of a recession. And that should be good for not only earnings growth, but for PE multiples. So to me, all of this, I think, is a pretty good backdrop. That doesn't mean turbulence couldn't happen. So, Jod, I guess, I think people kind of view the idea that there could be caution as like a dirty word. It shouldn't be. I mean, this is a stock market, and people should be prepared to buy dips if there are.
Yeah, and we're coming into the 2 weeks of peak earnings season, Tom, to your point. Plus, right behind that, we do have this election. So the next couple of weeks will be ones to watch here for investors. You just mentioned housing, though, Tom, and I do want to get your call on that because you're bullish on the home builders, and you say there's historical precedent for this.
Yes. The reason we highlighted the trade today is that since 1999, believe it or not, there's a 6-month window when home builders enter a golden 6-month period. It's something we've been writing about at Fundstrat for a better part of a decade, and the trade's worked 12 of the last 15 years. But from October 20th to April 29th, home builders have outperformed the S&P by an average of almost 1,900 basis points. So all of the gains home builders make typically occur those 6 months. I can't explain the seasonality, but the backdrop is better today because the Fed is cutting at a time when there's pent-up demand. And the home builders have actually done a very good job of capital management. So to us, it looks like a trade that should work this year.